Hello everyone and welcome back to these sessions on financial management. Friends, in this class of financial management, we will begin our discussion with a topic that you have learnt a bit at your foundation level, titled as time value of money. But let me tell you, when I start the classes at intermediate level, it will be always my presumption that students have no knowledge about time value of money. So I will be sorry for having that wrong assumption, but please let me survive with that assumption. I would want to really assume that you have no idea about time value of money. So I will give you explanation right from the scratch, and I want you to carefully understand each and everything. What happens, many a times I have seen students at foundation level, they have learned calculations of present value, future value, present value of annuity, future value of annuity, but they fail to realize why they are doing all those calculations, and they are simply making calculations. That is not the objective, and that is why I don't want to have an assumption that you have learned this topic at foundation level. Let me begin with the assumption that you have no idea about what is time value of money. So let us begin our discussion with this point. What is time value of money? Money will undergo a change in its value. I repeat, money will undergo a change in its value when the passage of time occurs. So simplest example could be, if I am investing rupees 10,000 today in some bank or financial institution, suppose the rate of interest involved over there is 12% per annum, then 10,000 rupees of today after 1 year will be growing, right? It will be growing with the passage of time. So today it is 10,000, after 1 year it will not remain 10,000, with 12% interest added to that, because simple point is, when you make investment, you will earn interest income out of that. So when you make investment, you will earn interest income, and that interest income will get added to the amount that you have invested. So amount invested is 10,000, and the amount that gets accumulated by the end of 1 year will be 10,000 plus 12% interest. 12% of 10,000 will be 1,200. When 1,200 added to 10,000, it becomes, on a cumulative basis, rupees 11,200. Means we have two different periods of time. One is the time which is now, and one is the time after 1 year. Time now, it will be having value of rupees 10,000, and time after 1 year, the same money will have increased value, that is 11,200. So rupees 10,000 of today, in 1 year's passage of time, it is changing its value, it is increasing in its value, and it is becoming 11,200. 10,000 of today after 1 year becomes 11,200. So 10,000 is the present value and 11,200 is the future value. The change in this value is occurring because of two components: passage of time and the interest rate involved over there. So typically, nobody would want to keep their money idle. If nobody wants to keep their money idle, of course you are going to invest your money, and when you invest your money will grow. So rupees 10,000 of today is becoming rupees 11,200. So 10,000 we would address as present value, and 11,200 we will address as future value. So all the concept of this present value and future value, how we are going to link up and how we are going to understand this whole thing, that is all clubbed in this topic, time value of money. So let me do one thing over here. Let me give you some important notes. First of all, under the heading time value of money, you may please write up this small concept of present value. If rupees 10,000 invested today at 12% per annum, after 1 year it will become rupees 11,200. This is what I have just explained in that example given to you. Therefore, rupees 11,200 can be considered as future value of today's rupees 10,000. In other words, rupees 10,000 is the present value of what amount? An amount of rupees 11,200 which is receivable after 1 year at interest of 12% per annum. And then an important line, present value of rupee 1 is expressed as 1 plus I raised to minus n, where I indicates the rate of interest and n indicates the number of years. Let us move ahead and look into what we have ahead. Consider the following example. Rupees 10 lakh invested today for 3 years at interest rate of 10% per annum will have maturity value of rupees 13 lakh 31,000 after 3 years as determined below. Now, how can today's 10 lakh become rupees 13 lakh 31,000 after 3 years? Let us try to observe. So, the present value is 10 lakhs. This is the money that you have invested at the beginning of the year. During the year, you will be earning 10% interest on that. 10% of 10 lakhs is rupees 1 lakh. So, your cumulative value by end of the first year will become 11 lakhs, correct? In the second year, you will earn 10% interest, but the amount of your investment has got accumulated to 11 lakhs. So, now you will earn 10% interest in the second year, but that 10% now you will earn on 11 lakhs, not on 10 lakhs. So, 10% of 11 lakhs is 1 lakh 10,000. Clubbing that, the accumulated value by end of second year becomes 12 lakh 10,000. Then you add third year's interest, which will be 10% on 12 lakh 10,000, and the amount of interest comes to 1 lakh 21,000. The total value that you accumulate by end of 3 years is 13 lakh 31,000. Let me explain you something very important over here. As per this working, rupees 10 lakh of today is becoming 13 lakh 31,000 after 3 years. If you can recall, at your school days, you would have learned simple interest and compound interest concept in mathematics. What is simple interest? When you keep earning interest only on the principal. But what is compound interest and what is the meaning of compounding of interest? When you earn interest on your investment and that interest is added to the base value of your investment, in the next year you will start earning interest on that compounded value, on that cumulative value. Means when you start earning interest on interest, that is what we call as compounding of interest. So this working has been presented like this over here, but if you use compound interest formula, you can calculate the same thing. I'll just help you recollect that compound interest formula. Do you remember a formula that you would have learned? F equals to P into 1 plus I raised to n. F stands for future value. P is the present value. 1 plus I is the indication of interest rate, and raised to n, that is power n, is indicating, n indicates the number of years. So basically on your calculator, if you take 1 plus I raised to n, that means 1 plus 10%. 1 plus 10% means 1 plus 10% of 1. On absolute basis, it will be written as 0.1. Mind it, when I say 10% means it is 10 by 100, correct? When I say 10%, it is 10 by 100. When you pick your calculator and make the calculation 10 by 100, it will give you 0.1. So when I say 1 plus I, it means 1 plus 10% or 1 plus 0.1. Time involved over here is 3 years. So 1 plus 0.1 raised to 3. So what I'll do is I'll pick my calculator over here. See, on my calculator I am taking 1.1 into 1.1 and again into 1.1. I'll be getting 1.1 raised to 3 times as 1.331, and this when I multiply to the present value of 10 lakhs, it will eventually give me the same thing, that is 13 lakh 31,000. So if I am multiplying this to 10 lakhs, it is giving me 13 lakh 31,000. So what you get as 1.1 raised to 3 you multiply that to the principal amount, what you have invested today, and you get the cumulative amount of maturity. That cumulative amount of maturity is the future value, and the amount that you have invested today is the present value. So let us do one thing, let us even write up that whole matter. So let us move ahead from here and write up that calculation as well. Alternatively, future value can be determined as given below. F equals to P into 1 plus I raised to N, that will be 10 lakhs into 1 plus 10% raised to 3, or 10 lakhs into 1 plus 0.1 raised to 3, or 10 lakhs into 1.1 raised to 3. So first of all, 1.1 raised to 3 you can calculate on your calculator, and that comes to 1.331. when that multiplies to 10 lakhs, what you eventually get as future value is 13,31,000. Let us move ahead and continue writing further. So the formula that you have applied is F equals to P into 1 plus I raised to N. If I cross multiply, what do I get? P equals to F divided by 1 plus I raised to N. In other words, I can get P equals to F into 1 upon 1 plus I raised to N. Now over here, during the school days, again in your mathematics, you would have learned one very important thing about indices and exponent values. You know, if I write 1 upon x raised to n, it is indicating inverse of x raised to n, and inverse of x to the power n can also be mentioned as x to the power minus n. So just use your simple common sense and tell me, when we write something like this over here, something like this, 1 upon 1 plus I raised to n, if I have to rewrite this in different form, I can simply write this as 1 plus I raised to minus n, and therefore f into 1 upon 1 plus I raised to n can be actually written as f into 1 plus I raised to minus n. What we need to do is we need to move ahead and write up something additional over here, that is the repetition of this formula, f equals to P into 1 plus I raised to n. This is the formula that you will be using for computing future value from a given present value, whereas P equals to f into 1 plus I raised to minus n, this is the formula that you will be using for computing present value from a given future value. So the variables that are used in this equation, f stands for future value, P stands for present value, I is interest rate, and n is number of years. Time for me to show you a very important calculation over here on your calculator. If you are investing 10 lakh today, after 3 years it is becoming 13,31,000. That means 10 lakhs is the present value and 13,31,000 is the future value. In other words, if I am knowing that 13,31,000 is the future value, and if I ask you to determine its present value, you will be getting exactly 10 lakhs. So let me put this example little differently. If you are going to receive rupees 13,31,000 after 3 years with 10% rate of interest, what will be its present value? Basically, we know the answer, that the present value will be rupees 10 lakhs. But how to compute the same? So I am picking my calculator, and what I am doing on my calculator, you also should try doing that. I will take f, that is future value, into 1 plus I raised to minus n. When I say 1 plus I raised to minus n, it will be 1 upon 1 plus I raised to n. Over here, I indicates interest rate. That means it is 10%, and 10% in absolute basis will be expressed as 0.1. So 1 plus 0.1 will give you 1.1. So I don't have to take 1.1 directly. I will have to take 1 upon 1.1 because it is 1.1 raised to minus 3 because it is 3 years involvement. So I repeat the whole matter. We are going to receive rupees 13,31,000 after 3 years. So what will be its present value? How would you compute that present value? So present value is basically expressed as 1 plus I raised to minus n. In our example, I is interest rate, which is 10%, that is 0.1. So it will be 1 plus 0.1 raised to minus 3, because number of years involved is 3 years. So 1 plus 0.1 raised to minus 3 can be rewritten as 1 upon 1 plus 0.1 raised to 3, that means 1 upon 1.1 raised to 3. Now on your calculator, how you need to do that, I'll show you. So let us observe what has to be done on the calculator. So it is 1, can you see, I am pressing 1, then this symbol divide by, then I am taking 1.1, so it is 1 divided by 1.1, simply pressing equal to 3 times. Look at this, when I press equal to 3 times, 1, 2 and 3, I am getting 1.1 raised to minus 3 on calculator screen directly as 0.7513148, something like that. This is the value that I am getting on my calculator screen. That means this is the present value factor. When I multiply this present value factor to the future value, that will be 13,31,000, I get exactly 10 lakhs on my calculator screen. What we have just understood right now, what we have just understood is basically how to use your calculator to determine the present value. And what I'll do now is, on the screen I'll show you the same thing in how to write up this as an example. So determine the PV, PV stands for present value, determine the PV of rupees 13,31,000 receivable after 3 years, where interest rate is based on annual compounding, and that is 10% per annum. So present value factor, PV factor, will be expressed as 1 plus I raised to minus n, that will be in this case 1 plus 0.1 raised to minus 3, and that will be actually expressed as 1 upon 1 plus I raised to n, means 1 upon 1 plus 0.1 raised to 3. And when you do it on your calculator, what we are getting is a factor like this, 0.7513148,009. This is the entire value that will appear on your calculator screen. And then when you multiply 13,31,000 to that present value factor, you will be getting the present value of that future amount, and that comes to exactly rupees 10 lakhs. This is how you will always compute the present value of any future amount given to you. Let us move ahead and take up some more practice situations like this. Dealing with question number 1 from your book, the very first question in this chapter, Fundamentals of Financial Management. Question number 1, it says determine the present value of the following, and you have 3 different amounts given as future values, and you are supposed to find the present value. So the very first requirement over here is determining present value of rupees 10 lakh, which is receivable after 4 years at interest rate of 12% per annum. So if I have to find the present value of an amount which is rupees 10 lakhs, which is intended to be receivable after 4 years, and the interest rate applicable over here is 12% per annum, what I would simply do on my calculator, I will take 1 divided by 1.12. I will take 1 divided by 1.12. That is basically inverse of 1 plus I. 1 plus I means 1 plus 0.12 or 1 plus 12%, whatever you say. So 1 plus 12% is 1.12. Inverse of that will be 1 upon 1.12. but I want to apply the power over here as 4 because it is 4 years involved. So 1 divided by 1.12 and I press equal to 4 times. 1, 2, 3, 4. What I get on my calculator screen is 0.635518. I repeat, 0.635518. If you want, I can repeat this calculation for you. 1 divided by 1.12 and pressing equal to 4 times. 1, 2, 3, 4. What I get on my calculator screen, it is 0.635518. This is the present value factor, and the amount that I am going to receive is rupees 10 lakhs. 10 lakhs multiplied to this factor, the present value of that 10 lakhs will come to 6,35,518. So how to express this as an answer to be presented as a proper solution? Just let us try to look at it. PV factors are always computed by taking 1 plus I raised to minus n. So in this case it will be 1 plus 12 by 100 raised to minus 4, because 12% is basically 12 by 100. So I will be 0.12. So it will be 1 plus 0.12 raised to minus 4. In other words, it will be 1 upon 1.12 raised to 4, and that comes to 0.635518. Now please look at this factor. This is called present value factor because this factor will convert a future value into present value. This is called a present value factor. Now this is 0.635518. When we multiply this to 10 lakhs, that is the future value, you will be getting the present value as a result. So we can say, therefore present value of rupees 10 lakhs receivable after 4 years will be future value multiplied by PV factor, that is rupees 10 lakhs multiplied by 0.635518, and that present value comes to rupees 6,35,518. Do you know what is the implication of this calculation? It means that suppose you have rupees 6,35,518 today and you invest it for 4 years at interest rate of 12% per annum. After 4 years, this value will actually become 10 lakhs. So 10 lakhs is the future value and 6,35,518 is the present value. So this is all about future value and present value. So out of the 3 segments in the question, I have explained you how to write the answer for the first one. I want you to now complete this in your notebook, and this is the answer for the first part. Now moving to the second part, the solution will be presented exactly in the same manner. So PV factors are expressed as 1 plus I raised to minus n. You know one thing, I indicates the interest rate and n indicates the number of years. Here in the second part of the question, the interest rate is 18%. 18% will actually be expressed as 18 by 100 and number of years are 5 years. So it will be 1 plus 18 by 100 raised to minus 5 or 1 plus 0.18 raised to minus 5 or 1 upon 1.18 raised to 5. When you apply the calculation on your calculator, do you know how you have to do that? 1 divided by 1.18 on your calculator and press equal to 5 times, you get the factor as 0.437109. So if the amount of 20 lakhs is receivable after 5 years, the present value of the same will be computed by multiplying that future value of 20 lakhs with the PV factor computed above, that is 20 lakhs multiplied by 0.437109, and that calculation comes to rupees 8,74,218. Let us move ahead and deal with the third part. Here also you will present the solution exactly in the same way. Here the interest rate is 15%, so it will be 15 by 100 or 0.15. So it will be 1 plus 0.15 raised to minus 3 or 1 upon 1.15 raised to 3, which will be the PV factor. Now PV factor, if you have to compute this on your calculator, what you need to do is 1 divided by 1.15 and press equal to 3 times. You will be getting that factor as 0.657516. So the amount of rupees 16 lakhs which is receivable after 3 years, its present value can be determined when you multiply that future value of 16 lakhs with the above computed present value factor, and that will be 16 lakhs into 0.657516, and that calculation comes to rupees 10,52,026. Let us move ahead, and time for us to take up the next question. Question number 2. Let us read this question. Determine the total present value of a series of cash flows receivable every year up to next 5 years, where applicable rate of interest is 10% per annum. Now we have a different variety of question over here. Please try to understand what exactly the question is asking you to do. This time it is not a single cash flow, but a series of cash flows. So not one cash flow, but a series of cash flows which will be receivable every year up to 5 years. Whenever you get a series of cash flows, you should look into that series of cash flows simply as, are the cash flows receivable every year same amount or different amounts? What I can see from the screen, that each of the 5 years the amount that you are going to receive are different amounts. So how would you find the total present value of these? That means as if you are having 5 different PV calculations, 5 different present value calculations. What you do is you find the present value of each one of these individually. So present value of the first cash flow which is receivable after 1 year, then present value of the second cash flow which is receivable after 2 years from now, present value of the third cash flow which is receivable at the end of 3rd year from now, and so on. Once you get present value of year 1 cash flow, present value of year 2 cash flow, present value of year 3 cash flow, mind it, what you are getting are present values. When you take the sum total of all those present values, it will be a lump sum cumulative present value, and that is what we call as total present value. So how would you do this? By calculation, very simple. If I look at the interest rate, it is 10%. So what will be the PV factor for the first year? So I take 1 divided by 1.1. If I press equal to 1 time, I will be getting 1 year's factor, which I am observing on the calculator screen as 0.909091. I am taking 6 places after decimal, 6 places. So 0.909091. If I press equal to 1 more time, I get 0.826446. This is the second year's factor. If I press equal to 1 more time, I get 0.751315. I press equal to 1 more time, I get 0.683013. This is the factor for 4th year, and another time I press equal to, I get the factor for 5 years. That is 0.620921. So I get 5 different cash flows in future. For each cash flow there is a different PV factor. The respective amount of cash flow when multiplied to the respective PV factor, you will be getting the present value of each of these cash flows, and the cumulative total of all these amounts of present value will be the total present value. So let us see how to present the solution over here. In your solution, what you need to do is just write up a table, and what you do is you start making the calculations, and let me explain you how to do. In the first year, you will receive a cash flow of 6 lakhs. You should first find the PV factor for that first year, which comes to 0.909091. Now how to get that PV factor, I have explained to you earlier, right? I have explained this to you. So this is the first year's PV factor, and first year's PV factor you will obtain by taking 1 divided by 1.1 and press equal to just once. Okay, so 0.909091 is what I am getting on my calculator. Actually speaking, on my calculator I get 0.90909090 recurring, but I am rounding it off to just 6 places after decimal. I told you. Now this value I multiply to 6 lakhs to get the PV of that cash flow. Do you know what I am getting on my calculator? 5,45,454.545. That 0.545 means it is not 5,45,454. It is something more than that. If that something more which comes after decimal, if it is 0.5 or more, you are going to increase the base value by rupee 1. So instead of writing that as 5,45,454, you will write that as 5,45,455 as I am showing over here on the screen. And let us carry out the calculation ahead for the next year. So second year, what is the amount of cash flow that you are getting? It is 7,20,000. So what will be the PV factor for the second year? So what I'll do is 1 divided by 1.1, press equal to twice, that is 1 and 2. We get 0.826446, and when I multiply that to 7,20,000, I am getting the present value of that cash flow as 5,95,041. In the same manner, you can proceed ahead and do all the other calculations. That will be for year 3, then followed by year 4, and then followed by year 5. Once you convert all these future cash flows to their respective present values, you can just add up all the present values of cash flows, and that will give you total PV of cash flows, which comes to 26,88,453, and that is nothing but the total PV of inflows. Let us move ahead and take up the next question, that is question number 3. Let us read this question. It says, determine the total present value of a series of cash flows receivable every year up to next 6 years, where applicable rate of interest is 15% per annum. And you have year 1, 2, 3, 4, 5, 6 and annual cash flow each year are different amounts of cash flows. So this is exactly similar to the question that you have just solved. So let us see how to write up the solution over here. In your solution, what you are supposed to do, you are supposed to present a table showing year cash flow, the present value factor at 15% and the present value of cash flows. Year 1, the cash flow is 3,20,000 and the present value factor comes to 0.869565 and the present value of cash flow comes to 2,78,261. Now with respect to rounding off these figures, let me explain something once again. So can you observe one thing, that the first year's factor was 0.869565. First of all, how to get this factor? 1 divided by 1.15, press equal to once 0.869565. When I multiply this factor to the first year's cash flow, that is 3,20,000, I am getting an amount like 2,78,260.8. 2,78,260.8. So after the decimal, it is a value which is greater than 0.5. So if it is 0.5 or greater than 0.5, you are going to round off the base value by adding 1 rupee. So instead of 260.8, we prefer writing 261 over there. These rounding of principles you should always keep into your mind. And let us check the calculation for the second year. In second year, what will be the factor? 1 divided by 1.15, pressing equal to 2 times 1, 2. Second year factor comes to 0.756144, or you can write basically 6144 or 6143, anything you write. When you multiply this factor to 3,40,000, you get the present value as 2,57,088.8 again. So again it is 088.8. So you need to round it off to the higher side, that is 089, because after decimal there was a value that was greater than 0.5. So if the value after decimal is 0.5 or greater than that, you will round it off to the higher side, and if it is less than 0.5, you will round it off to the lower side. So once you get these calculations, what I would suggest you is you can check the calculations like this for the other 3 years also. Other 4 years actually, and your total present value of cash flows should come to 13,65,047. My suggestion is, don't blindly copy these calculations. Make the calculations using your calculators and check with each calculation, understand each calculation, and then note it down. We can proceed ahead and write up the next heading under the concept of time value of money as concept of annuity. Now what is annuity? The term annuity refers to a constant amount of cash flow that will arise for a certain number of years. Now let us understand this with calculations over here. So question number 4 in your book, it indicates a project is capable of generating cash flow of rupees 8 lakhs per annum up to 6 years. That means each of the 6 years you will be generating cash flows, and the amount of cash flow each year will be same. That same amount of cash flow every year, that kind of series of cash flow is basically called annuity. So the question number 4 is asking you to determine the total PV of inflow if the discounting rate is 10% per annum. So what I am going to do over here, I will explain you one simple thing, that first of all, in the usual manner you can compute the present value of each of these 8 lakhs. So you can prepare a table, year 1, 2, 3, 4, 5, 6, 8 lakhs, 8 lakhs, 8 lakhs, 8 lakhs, 8 lakhs, like that. Then each year's PV factor you identify and mention it, and finally when you convert this into present value, each 8 lakh will be multiplied to its respective present value. Now what happens? Mathematically, if common amount is getting multiplied to each year's factor and then you are taking the sum total, you can actually go for a shortcut, because 8 lakhs, 8 lakhs, 8 lakhs is common amount. You take it outside, you first add up all the PV factors, you take the grand total of the PV factors, and to that you directly multiply 8 lakhs. It will make your calculations shorter. So what I am asking you to do is, first you make the calculation in details by making a table and showing the calculation as they should have been, and then I give you that particular shortcut. So let us do one thing. Let us first write up the solution based on the detailed calculation for each year separately. So here what we do is, we make up a table and we start with year 1. The year 1 cash flow multiplied to its present value factor, year 2 cash flow multiplied to its PV factor, year 3 cash flow multiplied to its PV factor. When you keep doing this for each of the 6 years, by end of 6 years you get 6 different amounts of present values which can be totaled up, and that can be the total PV of future cash flows. That comes to 34,84,208. So please look into one thing, as a shortcut when you are dealing with annuities like this, each 8 lakh you are multiplying to respective present value factor, and the final amount what you are getting you are adding up. So mathematically, do you know what is happening? 8 lakh into this factor plus another 8 lakh into this factor plus another 8 lakh into this factor. If I don't do this, instead I take all these as common value outside the bracket, and within the bracket if I take aggregate of all these, I will directly get the cumulative PV factor. Cumulative PV factor can also be known as annuity factor. Let me show you by calculation on your calculator how to do it. On your calculator how to do it, let me show you. So on your calculator what you need to do is, the rate of interest is 10% and the period is 6 years. So what I'll do is 1 divided by 1.1, press equal to 6 times, 1, 2, 3, 4, 5, 6. So what will be appearing on the calculator screen is 0.564474, something like that. This is the 6th year's factor. This is the 6th year's factor. In your calculator there will be function as GT. GT stands for grand total. If you press GT, you will be getting aggregate of all these directly as 4.355260069, or you can just round it off in 6 places after decimal as 4.355261. When you multiply this to 8 lakhs, you directly get this final amount, that is 34,84,208. So what I want you all to do is write up that other variation of your answer as well. So whenever you are getting a case of annuity, you should do something like this as an alternative method. PV of an annuity at 10% per annum for 6 years is 4.355261. Therefore, total PV of an annuity of rupees 8 lakhs per annum will be 8 lakhs multiplied by that annuity factor, and you get 34,84,208.55. So I can round it off to the higher side, that is 209. Can you notice one thing, that in the previous calculation it was 208 at the end and now you are getting 209. So there is a fractional difference, and because of that rounding of difference, this difference is just going to arise and you cannot actually do anything to that. This much rounding of difference is acceptable. Let us move ahead and take up a similar question like that. That will be question number 7 in your book. This question reads like this: calculate the total present value of an annuity of rupees 2 lakhs receivable at end of each year up to 10 years. Applicable discounting rate is 15% per annum. So here you may be wondering about what is this discounting rate. I'll explain you what is this discounting rate. Basically, this is nothing but the interest rate, nothing but the interest rate. But why it is called discounting rate, I have yet to explain it to you. I'll explain that in details. But as of now, what I want you all to do is you simply just write up this calculation, and I'll show you how to present the answer. In your solution, you just mention that PV of annuity at 15% for 10 years is 5.018769. How to get this 5.018769 as annuity factor, I have explained you already earlier. Total PV of an annuity will be multiplication of the annual cash flow of that annuity amount, that is 2 lakhs every year, multiplied by annuity factor, and that will give you 10,03,754. So just in 2 lines you can complete your answer if you are following this kind of annuity based approach. If some students would be still wondering how to get this annuity factor, sir, can you please show again? Yes, definitely I can show it again to you. Look at one thing, the time period involved over here is 10 years and the interest rate is 15% per annum. Discounting rate is nothing but interest rate. I told you that what is the meaning of discounting rate, why interest rate in this kind of situation of time value of money is also referred to as discounting rate. I have yet to explain it to you. Keep patience, I'll come to that. But let me first show you this calculation. So it is 15%. So I take 1 divided by 1.15 and it is 10 years period involved. So I press equal to 10 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. When I reach up to this stage, I want the cumulative value. On your calculator there is a function titled as GT, that is grand total. Press GT and you get 5.018768. So you can round it off to 877, and or you can round it off to 8769, whatever. So once you get that factor multiplied to annual cash flow of 2 lakhs, you will get the total present value of this annuity. So please check it again, and once you have completed this, we shall move ahead. Alright friends, I am sure by now you have completed this. Now I can assume that there may be some students wondering that why don't we learn how to compute this when that function gt is not given in the calculator. So not all calculator models have that gt function. So first of all, if your calculator does not have gt function, discard that calculator. I asked you what would be price of calculator in the earlier class. If you remember, price of calculator would be some 200-300 rupees. Now if you are compromising with that investment of 200-300 and not having gt in your calculator, it is not a good practice. I would suggest you to have a calculator which has that gt function, so that not just now but ahead in your calculations and financial management learnings, you will not be just having at this stage, even ahead, and when you come to final CA you will need this kind of calculator anyway. So it is good to have that kind of calculator with gt function right from now. But still, if you don't want to have it, there is no compulsion. I cannot compel you. My role is to explain you how to compute that amount even when gt function is not there in your calculator. See, smart calculations are always welcomed. I'll show you an alternate way of calculating if there is no gt function. See what I'm doing. The question is asking you what? 15% is the interest rate and 10 years is the period, correct? So 15% for 10 years. So what I am doing first is 1 divided by 1.15. 1 divided by 1.15. This equal to sign I will press 10 times. 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10. Whatever I am getting is the 10th year factor. If I press this gt, I will get the answer what I want, that is 5.01876, something like that. Correct? I get what I want. But sir, the problem is not this. The problem that we are facing is that we don't have gt in our calculator. Sir, you have gt in your calculator. Okay, I understand. Let me explain. When you are not supposed to use this function, still you can get that calculation accurately. See, 1 divided by 1.15 and then press equal to 10 times. 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10. Till here the process is same, right? If you have gt, press gt. Sir, we don't have gt. Yes, I know you don't have gt. If you don't have gt, you can still make the calculation. How? From this value what you got on your calculator screen, this is the value. Okay, this is the value. Make sure that your calculator is displaying this value already, because you have done this calculation along with me. From this value you subtract 1. So minus 1 and see what you get. You get negative 0.7528 something like. Okay, and now what you do is, because the interest rate is given as 15%, divide this by 0.15 and see what you get. You get exactly 5.018768 something like that. So 5.018769 as a rounded off value. So did you notice what I did? From the final figure what you got, from that you subtract 1 and divide it by interest rate. Let me show it to you once again. So what I am doing once again, see, 1 divided by 1.15. When you do that, press equal to 10 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. After getting this as present value factor for the last year, that is 10th year. This is what is appearing on your calculator screen if you check. From this you should subtract 1, that is minus 1 from this, correct, and divided by, from that you subtract 1, whatever you get, divided by interest rate. What is interest rate in this case? 15%. 15% will be expressed as 0.15. So divide this by 0.15 and check what you get. You will get that same factor. Can you see your calculator screen? 5.018769. Maybe that there is a negative sign appearing over here. Just ignore that negative sign and your task will be done. So finally we land up again from where we have left. So that annuity factor, when it is multiplied to the annual cash flow of rupees 2 lakhs, or I would say the amount of annuity of 2 lakhs, 2 lakhs multiplied by the annuity factor will give you the total present value of the cash flows, and that comes to 10,03,754. So I am sure you have already taken note of the same. Let us move ahead and take up the next point of discussion, that is concept of net present value. Let me tell you, I am not going to explain the logical meaning of net present value in today's class. I am just going to tell you how to determine net present value. Mind it, I am not conveying the meaning of net present value. I am telling you how to determine the net present value. It will be total present value of cash inflows minus total present value of cash outflows. If the resulting NPV is positive, the investment is beneficial. If the resulting NPV is negative, the investment is not beneficial. Therefore, an investment proposal should not be accepted when the resulting NPV is negative. Let us move ahead and take up a calculative example on the same that will be given as in question number 5. Let us read this question. In question number 5, what is given? A project has a life of 5 years. The cash inflow in the first year is rupees 8 lakhs. The cash inflow in each of the further years will increase by rupees 20,000 as compared to previous year. That means the first year cash flow will be 8 lakhs. The second year cash flow will be 8,20,000, that is 20,000 more than the previous year. Third year cash flow will be 8,40,000, that is yet 20,000 more than its previous year. So every year cash flow will go on increasing by 20,000 as compared to what it was in the previous year. The applicable rate of interest is 12% per annum. The cost of the project is rupees 26 lakhs. Determine the following: total PV of inflows, NPV and profitability index. So as I told you, I have not explained you what is the meaning of net present value. I have not explained you what is profitability index. We will just learn in this question how to determine these values. Now, first of all, what is the life of the project? 5 years. That means the project will provide you income in the form of cash inflows each year for 5 years. And how much will be the amount of those cash inflows each year? First year 8 lakh, second year 8,20,000, third year 8,40,000, then 8,60,000 and then 8,80,000. We will convert all these cash inflows into their present values, and that will be the total present value of cash inflow. From that, when you subtract 26 lakhs, it will be the present value of cash outflow, and the net amount resulting will be the net present value. Let me show you how to do these calculations. So in your solution, you can draw this table the way we had been doing it earlier. Year 1 cash flow, its PV factor at 12% interest rate and the PV of cash flows. Year 2, can you notice in the year 2 the cash flow has increased by 20,000 as compared to year 1, then year 3, then year 4 and then year 5. 5 years is the life of the project. So total PV of future cash flows, it is coming to 30,11,761. We have obtained the total PV of future cash flows, that is basically the present value of all the future cash inflows. That means this project has life of 5 years. Over its life of 5 years, it is going to produce all these cash inflows for you. That means you are going to receive this money. I repeat, you are going to receive this money. If you add up all these, it will be a big amount, right? It will be something greater than 42 lakhs. But have you noticed its present value is only 30,11,761. So if you add up all these cash inflows, it will be a big amount, but the present value of the same is today's value, because these cash flows you will be receiving in future. This is the present value of the money that you are going to receive. But this project is not available free of cost. To put investment in this project, the money that is going to go out of your pocket is the initial investment required in the project, which will be available to you as the total present value of cash outflows. So let me tell you, this is the total present value of cash inflow. So when we take the matter ahead, what we would say, NPV, that is net present value, is the total present value of cash inflows minus total present value of cash outflows. So what we just found, total present value of cash inflow was 30,11,761. You should understand what this amount is. This is the present value of all the money that you are going to receive, and to invest into this project you need to spend 26 lakhs now. That means this is the present value of money that goes out of your pocket. I repeat, this is the present value of money that comes into your pocket, and this is the present value of money that goes out of your pocket. This is the present value of money that you will receive, and this is the present value of money that you will have to pay, and that is why the difference between these two is considered as net present value. Before you start writing, I have one thing to explain over here. This net present value, can you see the inflow at its present value is greater than the outflow at its present value, means inflows are more than outflows in terms of present value. That is why the NPV is positive. When NPV is positive, making this investment is beneficial. When NPV is negative, making this investment will not be beneficial. Now can you notice one thing, once we get these two figures, total PV of inflow and total PV of outflow, their difference will be identified as NPV. But if you take the ratio of these two factors, total PV of cash inflow divided by total PV of cash outflow, that will give you what? 30,11,761 divided by 26 lakhs. That ratio is called profitability index. Total PV of inflow divided by total PV of outflow, that is 30,11,761 divided by 26 lakhs, and that gives you 1.1584. Mind it, I have yet to explain you the logical meaning of NPV and how to interpret NPV, the logical meaning of profitability index and how to interpret the outcome of profitability index. All that discussion is yet to happen. Right now my focus point is only one thing, how to make these calculations, and that is what I have explained you. Let us move ahead and take up the next question, that is question number 6. Let us read this question. X Limited is planning to invest rupees 20 lakhs in a project at present. The life of the project will be 8 years and the annual cash flows over its life are estimated as below. Year 1, 2, 3, 4, 5, 6, 7, 8 and annual cash flows in each of these 8 years have been given. And what we can identify that cash flows are not uniform. These are different amount of cash flows. Okay. You are required to compute the net present value of the project if the expected rate of return is 15% per annum. So this expected rate of return, or you can call it as interest rate or discounting rate, is given as 15% per annum. 20 lakhs is the present value of cash outflow. and these are the amounts of cash inflows. These are the amount of cash inflows. So what you will first do is you will convert all these cash inflows into their present values. Once you convert all these cash flows into their present values, you will be getting the total present value of cash inflow, and 20 lakhs is the present value of cash outflow. So from the present value of cash inflow, when you subtract the present value of cash outflow, you will be getting the net present value. The idea is simple. If the net present value is a positive amount, the investment in the project will be beneficial. Otherwise, the investment in the project will not be beneficial. So let us move ahead and look into how to present the solution over here. We have 4 columns: year, cash flows, PV factors and PV of cash flows. So first year cash flow and PV factor respectively multiplied, you get the present value of cash flow. Second year, do the same thing. Third year, do the same thing. How to do this we have been doing in all the earlier questions, so this is nothing new for you at all. This you have been doing in past so many questions already. So each of these cash flows are being converted to their present values, and the life of the project is 8 years. So till 8 years you are going to make these calculations. Then when you sum up all these present values of cash flows, you will be getting the total PV of cash inflows, and the total PV of cash outflow is given to you as 20 lakhs. The resulting net present value is a positive amount, 1,54,094. So through just this much presentation, your entire solution is complete, and that will be end of the solution. Let us move ahead and take up the next question, that is question number 8. What is seen over here? X Limited is planning to invest rupees 20 lakhs in a project at present. The life of the project will be 8 years. The annual cash flow over its life are estimated to be rupees 4,92,000 per annum. Look at this, look at this, look at this. 4,92,000 per annum. For how many years? For 8 years. That means each year it will be same amount each year. If it is same amount each year, then presenting the big calculation table is not needed. You can smartly use concept of annuity and apply annuity factor over this amount of 4,92,000. So how would you compute annuity factor? With the expected rate of return as 15%, you know what you have to do. 1 divided by 1.15, press equal to 8 times for 8 years, and once you get the last year factor, just apply GT. I have explained you this thing earlier in the questions. Apply GT and you will get the grand total as the annuity factor. That annuity factor you should multiply to 4,92,000 to get the total PV of inflows, and from that when you subtract 20 lakhs, which is the total PV of outflow, you will be getting the net present value. So let me show you how to present the solution over here. You first write that PV of annuity at 15% for 8 years is 4.487321. So if you want to check how we got this, let us check it again. 1 divided by 1.15, I am pressing equal to 8 times. 1, 2, 3, 4, 5, 6, 7, 8. What I get on my calculator screen is 0.32690177, something like that. If I apply GT, I get 4.487321. Actually it is 215, so you may round it off to 22 also, and then to this you multiply the annuity of 4,92,000. So this multiplied to 4,92,000, you get 22,07,762.18. So I am just writing 22,07,762. This I will call as total PV of future cash inflows, and from this I will subtract the total PV of cash outflows, and what I get is the net present value. Let us move ahead and write some important notes. These notes are very, very important. I will ask you to just write these notes and after these notes have been written, it is in the later classes I'll give you detailed explanation of these notes, but these notes are very very important. Let us start writing these notes. Point number 1, the present value of any cash flow will be obviously less than the cash flow itself. Such present value is therefore also known as discounted cash flow. The rate of interest which is used for determining the present value of cash flow is also known as discounting rate. The discounting rate indicates the expected rate of return for the investor. It is also known as cutoff rate, which indicates minimum rate of return that is expected. If the investment project is capable of generating rate of return higher than the cutoff rate, then investing in such project is definitely beneficial. It indicates positive NPV. When NPV is positive, it indicates that the project is capable of generating rate of return which is higher than the cutoff rate. So I have told you that I haven't explained any of these points. What I just want you all to do is carefully take note of this whole thing, and in the next class I'll definitely cover the explanation of all these points, not just in one class. In lots of classes coming ahead you will be understanding this whole thing.